Hi everyone, I'm Jason with Level Up Investing, and in this video I'm going to do an update on Wells Fargo stock. And if you have not seen the previous video on Wells Fargo that I did, which talked about why I'm investing in Wells Fargo and an update as to why I am continuing to invest, I'm going to put a video up here in this in the corner here. So take a look at that and then come on back and take a look at this video as an update. So Wells Fargo continues to be in the news given the current economic situation, the interaction with the Federal Reserve, and also the first quarter 2020 financials result. So I'm going to go over the company itself, some of the newest items in the news, as well as the new financials. Take a look at the most recent 10K as well. And then finally, I'll wrap this video up with my overall assessment based on all that information and what my current plan is. So let's get right into it. Okay, so for company news, you can see this article that was posted about a month ago, and it talks about the new CEO of Wells Fargo, Charles Scharf. And it turns out that he is the third CEO at Wells Fargo in the past 4 years. He comes in with a lot of banking and technology experience, having worked in Visa and Bank of New York Mellon. And the plan for him is to come in and really change the culture, improve the culture and the operations, given the recent issues with Wells Fargo, with some of the regulatory issues that have been happening with the fake accounts and all that. So he's here to really clean up the company. And apparently, according to reports that I've been seeing, he's very well known and well liked in both the financial and the technology sectors. So here's an article from a month ago saying that the Wells Fargo and Company president just bought $5 million worth of shares. So, and it says he bought it at a stock price of $28.69. So again, that was about a month ago. And this, to me, this is just an indication of some level of optimism in the company that he just came into. So that's one big piece of news that occurred about a month ago. And it's always good to look at what kind of insider trading is happening in the company, especially when the top executives are buying large amounts of shares. That always, for me, plays an important role in my decision making. I mentioned the regulatory issues that Wells Fargo has been dealing with. So one of the issues is the asset cap that was placed on Wells Fargo in order to improve the company before the asset cap is lifted. So this was interesting. This was quite recent here on April 8th. The Fed has Fed modifying the asset cap so Wells Fargo can make more small business loans. So this is happening in a time where jobless claims have gone up and companies are trying to survive. Companies are using their reserve cash and there's not a lot of it. So a lot of small businesses are requiring loans. So Wells Fargo is demonstrating here that it wants to continue to make loans to small businesses, and that is reflected in the financials. And so the fact that the Federal Reserve has modified the asset cap for Wells Fargo, to me, that's a good sign. That's an indication that if Wells Fargo can do well with these small businesses, that maybe that will give some latitude. I guess the word is more latitude for the Fed to potentially continue to modify the asset cap and perhaps lift the asset cap altogether in the future, sooner rather than later. So it'll be interesting to see what happens there. Also, it's important to recognize that the Fed is also allowing Wells Fargo and other large banks to continue to pay dividends. And that's what it says here. Fed gives banks a break to keep markets calm, asking for little in return. It says the Federal Reserve is giving banks room to maneuver with regulatory tweaks, just like we just mentioned, but it isn't barring them from paying dividends, fueling concerns that it is ignoring the lessons of the last crisis. So this is a controversial topic, obviously, because when there are stimulus packages happening and large banks receiving a stimulus package, the question that arises is, why should a large bank continue to have a stimulus if it continues to pay off its dividends to shareholders. And the criticism also would be that a bank like this would be better served keeping the dividends or keeping them as retained earnings in order to make sure that the operations continue and the bank continues to function. So as a shareholder, of course, I'm always interested in the dividends, but having a dividend is not necessarily the best thing if you're in it for the long haul, because it might be better for a company to retain their earnings more to number one, survive in an economic downturn, but also to invest and grow the company further. So that's what a company has to decide, whether they're going to continue to pay dividends or temporarily suspend them. So this is the key right now, is that the Federal Reserve is not requiring Wells Fargo and other banks to stop the dividends. But this is also something very important to follow as we move along in this current financial situation. Another piece of news that I found interesting was this. The Wells Fargo adds new top lobbyists to help revive image in Washington. So what's interesting is how Wells Fargo is really trying to invest in fixing the problems that it has had in the last couple of years. One of them is to hire this lobbyist in order to improve the image of the company in Washington, D.C. This article from just a couple days ago shows there Brian Smith, who joins Wells Fargo next month, says here that who spent the past decade with Regions Financial, will be in charge of the government relations and public policy team for Wells. Later in the article, it says here, the hiring of Smith drew praise in the Washington financial services community as a sign that the bank is committed to cleaning up its problems. Bank Policy Institute President Greg Baer, whose trade group counts Wells as a member, called Smith, quote, one of the most liked lobbyists in town, and, quote, smart, effective, and plugged in. So that's interesting because, this, again, to me, plays into the longevity of the company and the regulatory involvement. And so I think it's always interesting to keep an eye out for news items like this. So those are some of the recent news items with Wells Fargo. And let's now go into some of the financials. So this is the news release talking about the first quarter 2020 earnings result. So the Q1, the actual SEC filing, which is what I like to review, that has not come out yet. So I'm going to go based on this news release. So this shows you that the net income of $653 million and diluted earnings per share of 1 cent. And we'll see in a second here the actual breakdown of the numbers, but that already is an indication of how significant there has been a financial change in the company for this quarter. And it says here, included the impact of a reserve build of $3.1 billion or 56 cents per share, and an impairment of securities of $950 million or 17 cents per share, driven by economic and market conditions. Revenue of $17.7 billion, down from $21.6 billion in the first quarter of 2019. So let's go further into the earnings report here. And again, it's just the news release, and go into more details on this. So the news release talks about the reserve build of $3.1 billion for loans and debt securities. So what that's saying is that Wells Fargo is preparing. They're preparing for the upcoming loan defaults, mortgage defaults, and they're preparing to the tune of $3.1 billion. Now they also state in this news release that the liquidity coverage ratio of 121%, which continued to exceed the regulatory minimum of 100%. So basically stating that Wells Fargo has more than enough liquidity to cover expenses and defaults, and it just has the liquidity to make it through what they anticipate to be the upcoming issues with the economy. So because of this $3.1 billion reserve, that reserve was taken out from the earnings, which is why the earnings per share, the diluted earnings per share, was significantly lower, which we'll see here in the selected financial information. So in this chart, in the same document, shows you the diluted earnings per common share of, again, 1 cent per share. And if you compare that to the quarter ending year over year in March 31st, you can see that the diluted earnings is significantly down, previously $1.20 per share. And the net income in billions, 5.86 billion a year ago, and now 0.65 billion. Again, this net income significantly decreased because of the reserves that had to be set aside. It's important to keep in mind that this earnings per share is significantly lower now, and this is before the anticipated defaults that we're going to see because of the jobless rate and the overall situation with the economy. That it's going to be very interesting over the next couple quarters to see what these earnings are looking like, especially considering that these numbers are here even before those defaults occur. And you can see at the bottom of this chart the average loans in billions from 950 billion a year ago to 965 billion. So Wells Fargo continues to provide loans, and you can see here the net interest margin of 2.58%. So continuing to be active in its loan origination, but at the same time taking earnings and setting a lot of it aside for what's coming up in the future. And this document is the supplement to that same first quarter 2020 earnings report. The chart on the left shows you that decline in the diluted earnings per common share down to 1 cent. And on the right gives more details on the provision expense for credit loss we just described, as well as some further details on where they determine the diluted earnings per common share, which includes not just the monies set aside from the net income set aside to take into account the provision for the credit losses, but also some redemption of preferred stock. So bottom line, it shows that significant decrease in diluted EPS. This chart in the supplement also just puts it in graph form, the liquidity coverage ratio, which we mentioned earlier, 121%. Again, this would likely play into the regulatory issues that Wells Fargo is dealing with, and it shows the Federal Reserve, hey, look, we are keeping our liquidity up, and so maybe that could help with our asset cap removal in the future. And this is just an interesting chart that I saw showing where a lot of the commercial and industrial loans are being provided, what industries are receiving these loans, these lease financing options. And it's good to think about that now as you see the jobless claims, you see businesses either shutting down or having to require a stimulus in order to survive. So looking at where Wells Fargo has a lot of their loans out, so that the biggest being financials except banks. So what that really is the financial sector that's other than banks, but companies that provide financial goods like mortgages, stocks, bonds, insurance policies, commodities, and real estate. Not just the financial goods, but also the financial services that help customers obtain these goods. So services like actual stock brokerages or a mortgage broker or retirement companies or investment companies. So that's why that's a large number. That's the biggest one out of all of them. But it's interesting to look at the chart to see all the different types of retail, real estate, as well as other banks, all the way down to some of these other businesses. So this will be important to keep an eye out as we continue to follow the news over the next few months to see which industries are being hit hardest with the current economic situation. And again, this is I'm doing this video here in April of 2020, so we'll see how this goes throughout the coming year. And it's good to know that as I'm investing in Wells Fargo, I want to see which industries, as we see in the news, which ones are getting hit hardest, and how is that likely going to affect the balance sheet and the income statement for Wells Fargo. So speaking of balance sheets, I like to look at the Form 10-K, which is the annual SEC filing. And this here is for the fiscal year ending December 31st, 2019. And from this 10-K report, Exhibit 13, it shows the annual data, and looking down at the row for assets under balance sheet down there, you can see that the assets are relatively stable compared to 2018 and 2017. But also I like to look at the long-term debt and see what kind of changes are occurring. And here you can also see that it's pretty stable compared to the last couple years. Now, what is not so stable is the free cash flow. So looking at the consolidated statement of cash flows under the net cash provided by operating activities. So for these past 3 years, you can see quite variable from 18.6 billion to 36 billion, and now down to 6.7 billion. So significant drop and variability. Okay, so now that I've gone over the most recent news issues as well as the most recent financials, this is where I like to pull it all together to come up with my own plan with investing in Wells Fargo. So here's a chart that I pulled together which shows the free cash flow over the past, the annual free cash flow over the past 10 years. And you can see from the chart, quite variable like we just described. So with a variable cash flow like that, it makes it a little bit more challenging to determine future cash flows. Therefore, it makes it a little bit more challenging to determine an internal rate of return based on those cash flows, and therefore a correct buying price that I'm going to go with. So because it's so variable, I've had to become a lot more conservative with my anticipated growth rate. So I'm anticipating right now that at best there'd be an upper growth rate of 8% with a likelihood of about 25% predictive likelihood for that. The majority of my likelihood is more of a 65% at a 5% growth rate, 65% prediction. And then to round it out, a 10% prediction for a negative growth rate of -5. So I'm trying to be rather conservative. And so where am I coming up with these numbers? It's really based on the history of Wells Fargo, some of the things I just described, the financials, and my overall, basically my overall optimism that Wells Fargo is going to do well, and it's just going through some challenges right now, but is ultimately a very good company and a good stock to own for the long run. So based on that growth rate analysis, I've come up with a internal rate of return of 9.5% if I were to buy the stock at a stock price of $22. So at the time of this recording, the current stock price is at $28.38. The fact that I've created my own target buy price of $22, giving me an internal rate of return of 9.5%, that is factoring in the variable cash flow, the recent leadership changes, the interactions with the Federal Reserve, the fact that the asset cap is still there but is modified temporarily, the decline in the net income and diluted earnings per share, as well as the significant reserve build that's been placed. and overall the high level of uncertainty over this coming year. Because of that, I've factored all that in order to establish a more conservative buy price of $22. So my current plan is to hold my current Wells Fargo position, continue to watch the stock price to see if it gets closer to my buy price, which demonstrates my evaluation of the intrinsic value of the stock, and take into account the current uncertainties. So that is my current plan with Wells Fargo stock. And if you found value in this evaluation, then definitely give me a like in the video and subscribe to the channel. I'll be doing videos like this twice a week to evaluate stocks that I'm following and the current market conditions, the current financials. And as you can see, I really like to go into the actual financial data, the actual SEC filings, to really see what's happening with the companies to make the best decision for myself. You definitely want to do your own due diligence for your own decisions, but you can follow along with me to see what I'm doing in these videos. And I hope you enjoy the content, and I'll see you on the next video.